Well, ladies and gentlemen, welcome to Post FOMC Live. Wait a second. You know what? I hate this talk. What the hell's going on here? Yeah, I hate little bits on my top. Anyways, what do we need to know? You got your rate cut, ladies and gentlemen. Now what? What happened to the Fed pivot, Tino, man? I thought the market was going to correct. Ladies and gentlemen, we got a rate cut for sure. Did we get what we want? No. We wanted more rate cuts, courtesy of Donald Trump. We called it a tiny rate cut. He's not too happy. Today's live stream, I'm going to explain to you everything and where we are macroeconomically speaking. That's going to be covering a couple of things. We're going to be covering the story of where we are in relation to inflation. We're going to be diving into the labor market because apparently now the labor market is exactly what we need to be focusing on, right? We're going to be diving into some other things as well, the housing market, because these are all things that the Federal Reserve is relying on working properly just to get down to their dual mandate. It's the third mandate. You're telling me that Jerome Powell and his 19 peers are no longer interested in financial stability? Telling you, ladies and gentlemen, we don't have a problem with credit. We really don't. I've got charts to back it up for you. Once we've done all of that, ladies and gentlemen, we'll be diving into our dearly beloved Bitcoin. Is it going to pump? I don't know, man. Logic says that we should be pumping because interest rates are now coming down. Yield on the dollar is lower, so I don't really want to be in dollars, but everything's been going up. Is it really sell the news? It really is sell the news event. Jesus, NASDAQ. Why? You know what? I think I'm going to change my times, man, because I'm missing out on opportunities. I was just in a short on NASDAQ, right? And I closed it. Pre-markets don't really like to take trades, but I took a little short, made myself about $800. And I'm like, okay, there's a quick scalp. And that would have been a very nice scalp had I not pressed live. But you know what? I'm here for you guys. So let's break it all down. We can make money in the next half an hour. It's no problem. So let's break it all down. Make sense of the madness that's unfolding because everyone wants to, NASDAQ. No. I mean, look at it. Look at it. I was short here. Short here. Look, I just took the trade. Where is it? There it is right there. Where's, no, stop it. Don't reverse. Of course, it's not going to reverse. It just swept the all-time highs and took a burp. We just had some data, ladies and gentlemen. Unemployment market's doing all right, isn't it? Unemployment claims are coming lower. So let's get with the program, ladies and gentlemen. NASDAQ was up earlier, 1% as stocks rally after the Federal Reserve discussion. So let's get into the business and help you guys understand where we are, macroeconomically speaking, so that when you do go for a coffee with your friend, you're going to sound like, you know what? I know what's going on in the economic marketplace. Now, I don't know. I don't make out as if I do know what's going on. I'm just telling you what is going on. Whether we are right or wrong is a different story. But you know what? Let's make sense of it, guys. And hopefully I can put it in a way that's going to help you understand how to just maybe just perceive what's going on in the realm of uncertainty. In other words, the markets. Let's break it all down. Starts off with this. Steve Mirren, the dude, happens to be a good friend of Donald Trump, came out on the dot plot suggesting that we need lower rates. Okay, he favored a 50 basis point cut out of the 19 guys in the Federal Reserve. They're all the way up here. These guys are the economists, right? And this dude down here is pro-Trump, right? So he's got to represent Trump in some way, and he's done his bit. You know, Trump said, just do something, man. Just try and encourage them. Try and speak to all these dudes. Well, he ain't managed to do nothing. But this right here, this dot, shows you that Steve Mirren has the favor of more rate cuts. And that's what we're going to get. However, we just had some data come out. Where are you? 231,000 on the unemployment market. So that's a good reading. No, it's lower. That means there are less people claiming benefit. And the expectation was 241,000, but it came in at 231. Okay, and the manufacturing index has gone up. Look at that. So maybe Jerome Powell's right. Maybe the economy is okay from a manufacturing point of view. But hold on a second. Is the manufacturing sector only going up because of the story or the unknown story of what's going on with tariffs? I'm going to be helping you understand how to apply that logic to the data today. Let's get with the flavor. In front of you is the Personal Consumption Expenditure Price Index. This is what it's all about, okay? The PCE. Now, this is one of the main measures that the Federal Reserve uses to understand where we are economically speaking. What's the consumption? Who's spending money? Whenever it's above 2%, that's when the Federal Reserve says, you know what, we need to slow things down. And how do they do that? They increase the interest rates. NASDAQ, stop it. Stop it. Stop. No. No. Anyways, I'll get my back on you later on. When it's above 2%, that's when the Fed gets concerned. You can see when it shot up above 2% back in 2020, that's when they started to increase the interest rates. Gone are the days of zero. He said it last night. We ain't going to have zero anymore. It's impossible to have zero. It will break the markets. You can see here that we're starting to see a little bit of a climb. PCE going up, right? In front of you is the non-farm payrolls and then the employment rate. Now, last night they had said, or Jerome Powell had stated, that their expectation towards the end of the year is the unemployment rate is going to go to around 4.3, 4.5%. Is that good? That's wonderful. We're at the lowest in 50 years, ladies and gentlemen. And Biden did a good job of making sure there were jobs available, okay? It's the only time we're going to rate Biden because he said, you know, the employment market is doing great. And it is. We've got low unemployment rates, okay? Now, the last few readings that have been coming through haven't really been painting the picture that the labor market has been good. But the reason why the Federal Reserve has been keeping the interest rates high is because the labor market is sustaining itself. And if the labor market is sustaining itself, it means businesses are keeping people employed. That means people are spending money. That means inflation is going to stay higher for longer. That's why the interest rates were kept high. Now we're going to start doing something. Now take this with a pinch of salt. But let's just try and break this logic down, right? CPI, what is it? It's the main inflationary reading, consumer price index. So when you go to a shop and you say, you know what, I fancy those biscuits, or I fancy that pack of smokes, I fancy that bourbon. All right, you know what, I'm going to pick some up. You go to the till and you're like, happy days, let me pay $25, $30, whatever you're paying, okay? You come back the next week and then you realize that $25, $30 you paid has ended up becoming $25, $35. What's going on? And then you say to the guy, yo, man, why has this gone up? And you're like, come on, man, we got some costs coming into play. Don't you know what's going on with the tariffs? Hold on a second, Donald Trump. Did you not say that you are going to make sure that the US doesn't pay for the tariffs? Well, not according to this. It says that the tariffs so far are creating the cost for US businesses. Quote, we're going to be a tariff nation. It's not going to be a cost to you. It's going to be a cost to another country. Hold on a second. That's not... Whoa. You've gone and tariffed someone else and we have to pay for it. It says here that President Donald Trump promised during his recent campaign to impose steep tariffs on other countries, assuring voters that the cost would be paid by foreign sellers. No, ladies and gentlemen. Now, let's go back to the guy who went to the shop and bought the cigarettes and the bourbon, okay? He goes on and he takes the payment, happy days, comes back the next day, and then he's like, yo, can I have the same thing again? And the guy at the counter says, hold on a second, man, I've had to increase the cost of this. Well, what do you mean, man? Well, listen, man, when I go and buy it from China or I go and buy it from somewhere else, okay, when I get this stuff imported in, I have to pay more. And that means you have to pay more. That, ladies and gentlemen, is what you've got over here. Core price index, okay? The CPI. That's now gone up, okay? Now, the Federal Reserve's problem is this. Now that the unemployment rate is effectively gone to 4.3 and they're expecting it to now go to 4.5% or be stuck in the range of 4.3, 4.5%, what's the problem with that? Well, problem is it's still low and it's not high enough, which means that the possibility of the core price index going up in the future is more than likely. Inflationary risks are still high, courtesy of Jerome Powell. So with the CPI looking like it's going higher, and in the previous FOMC meeting, which was absolutely dog last night, I was not impressed with Jerome Powell. No coughing. He was bland as hell. No one was asking really provocative questions other than the fact that, is the Fed going to have a problem with its independence? And more so, are you going to quit in April? Well, he kind of just turned all of those conversations away. But if the core price index ends up going higher, okay, as a result of these tariffs that we don't know where we are with anyway, what's going on with China? Is it going to be made in China, made in the US? What's the story? Is Trump going to actually put the brakes on the actual tariffs? Maybe. The reason why the Federal Reserve right now is focusing on the labor market is because that is going to dictate where we're going to go with inflation. They're taking a risk by increasing the interest rates for the first time in cutting the interest rates for the first time in 30 years with inflation, or the PCE, above 2.9%. That's a problem. Why are you cutting the rates when inflationary figures are showing you 2.9%? Do you have a reason to cut the rates? This is where it starts to get a little bit interesting, ladies and gentlemen. The next thing that the Fed's trying to focus on is housing. How many of you right now are trying to go out and buy some houses? What if you're trying to sell? In front of you is the Zillow home inventory and mean days to pending. Let's just focus, rather than diving into this too much. I mean, I can, which I will in a second, but let's just look at something. We're starting to see a little bit of curvature coming into play, top side right here, starting to turn. Okay, so it's saying here that the Zillow for sale inventory, all homes, is starting to drop. And then, of course, the inventory for single-family homes is starting to drop too. Okay, but just look at where we are. This shady area here, if you can see it, is recession. We haven't had one yet. Okay, so it seems like we're doing all good, right? For every peak, there's a corrective move. For every peak, there's a corrective move. Every single year, it looks like we have a corrective move. Going into the top side of 2024, going into the earlier part of 2025, we see a peak at the top side here at 19th of October, 2024. It slumps all the way down and it bottoms out at 2025 January, okay? We're now peaking at the top side over here, surpassing all of this range at the top side over there, and we are now at the top of the 2nd of August, 2025. It looks like we could be getting a little bit of a contraction in this home inventory story. Let's back it up a little bit. New home sales. What's the story here? Remember, the Federal Reserve is focusing not on inflation anymore. It's not bothered about it. It's focusing on now the result of people's behavior, because that's what it all is. Consumer price index, okay? What are companies going to be charging the consumer for buying their product? What's the reason for them to having to increase the cost of their goods and services in the first place? Well, Jerome said tariffs ain't going to be a problem, but it looks like it could be something that's going to start to show surface in the future. In front of you is the new homes for sale. What this chart pretty much tells you is this. If builders have too much of a supply of houses and they're not being sold, they're going to be left scratching their bald heads. Because if there's no demand for the houses, then you're going to be left with an inventory of houses that need to be sold. By the way, this gray line here shows you a recession. This little gray line here shows you a mini recession. Okay? A very small one. But then it rallied back up again in terms of inventory and sales. Okay? We're starting to see something changing right now. You see the demand for home sales right here, new home sales month on month, okay? It's been very contradictory. It's been up, it's been down, it's been up, it's been down. It's not been consistent. And every time we see an expansion between the inventory and the sales, it could lead us into the idea that maybe, possibly, we could be going into a bit of a problem. I'm not going to say recession because people don't like that bad word, but we'll just say it's a little bit of a problem. Or even better, we'll say it's a little bit of a gray line right here. Okay? Household financial debt to disposable income. What does this tell you? Shows you that household financial debt is going up a little bit. Looks like it's a bit flat, but it's going up a little bit. Hold on a second. Did we not see this? Breaking: searches for help with mortgages surpassed that of 2008 housing crisis. Help with mortgages. Well, hold on. Do we really need help with mortgages? Let's be honest now. Mortgage rates are down. And you just got yourself an interest rate cut. Surely that's all good. Hold on. If people need help with mortgages by per se, okay, of where is it? Hold on. Help with mortgages for in terms of Google Trends, right? This is what Polymarket is saying, that people are Googling how to get help with a mortgage, okay? Well, if your interest rates are actually down and mortgage rates are down, okay, does that mean they need help? I mean, look, it's sort of easy to get a house right now. I mean, you're paying 6.35 on a 30-year, okay. So that must mean that if people are looking for help with mortgages, and then the idea that Donald Trump's going to possibly declare a housing emergency in 2025, that means that we have a very high delinquency rate when it comes to loans. Single-family residential mortgages, the black line, it's flat, okay? Commercial real estate loans, the red line, is flat. C&I loans, flat. Credit card loans moved up a little bit, but it's flat. So, what are you guys betting on? Help with mortgages? Surely it means that they just want to try and get some capital together. Let's be honest now. Where am I going with it? Financially speaking, the housing market and, of course, the labor market are leaving the Federal Reserve in a bit of a tricky situation. Historically, you don't cut interest rates when inflation is high, especially when it's nowhere near your mandated target of 2%. Last night was a wonderful breakdown of the Federal Reserve's credibility. It was. Now, when we start to consider other factors that are coming into play with, of course, the European bond restructure on definitive benefit or defined benefit and defined contribution, it's, the way the financial markets are going to work, right, is going to be different to the way the actual data or the economy itself is going to work. Because Powell said it. He was asked, are we going into a bubble? And he goes, I don't care about the market. It's got nothing to do with us. We're focusing on what's going on. We know that the unemployment rate is good, okay? If the unemployment rate is good, that means that there is a possibility that inflation could go up again. If the Federal Reserve board members are mixed on whether we should be cutting interest rates or not, ladies and gentlemen, don't get it twisted. This chart right here can change. Each dot is a participant. And if Trump is really trying to put pro-Trump ideas into the Federal Reserve, okay, the second Jerome Powell steps down, all right, he's going to get someone in and swoon in and cut the rates as much as they physically can. Because you got to think about it, your deficit is still going up. It doesn't matter. Your spending is way more than what you earned this month. So it clearly looks like they don't care. But if the unemployment market is still low and the housing market has now a reason for growth to come into play because the mortgage rates are coming down, ladies and gentlemen, the US, economically speaking, will look like it can never go into a recession in the future. Why? Because with the time when it was expected, it never came. Or what if it's a hidden recession? Who knows? But now that the yield on the dollar is now looking like it's going to come lower, the Federal Reserve last night pretty much explained that we need more data. More data. You gave us the most biggest change in the financial world, and you backed it with more data. So today's reading from the actual unemployment claims came in lower. That suggests that the future of rate cuts might not need to be a problem. Well, it could be a problem because if there's less people claiming benefit, there's more people out there getting work. And that means there's more people out there putting money into businesses' pockets, which means that's going to keep the economy moving. But at the same time, if tariffs are still going to be put into play because the economy can sustain itself per se, a manufacturing sector, well, the manufacturing sector is only going up because they need to protect themselves on the future costs of what business is going to look like when the tariffs do come into play. When's it going to blow? It looks like it doesn't, ladies and gentlemen. Looks like the US economy is playing Jenga, right? But each Jenga piece that they've been putting together has been sealed with cement. And that thing is not busting. Nothing at all. So, go and sell your nan. Go and donate your lungs. Because Everything's going to go up. Historically, when the Federal Reserve cuts interest rates, usually the S&P can go on for a bit of a 13.9% gain, right? Because we don't know where we are with the path of interest rates. Remember, the possibility of interest rates getting cut in the future is still there. We've not been told, here is your interest rate cut, that is it. We haven't been told that. We've been told that we potentially can have more rate cuts because the interest rates right now are still high. But the labor market is not giving you the reasons to believe that we are really in a problem yet. But like I said last night, financial stability, credit, is the only reason why the third mandate will be exercised and why the Federal Reserve should be cutting the rates if there is a problem financially. They are looking at behavior. They're not looking at the finance of things because you're already fucked anyway because your deficit is flying up. So it doesn't matter. So instead of focusing on inflation that they have been for the last how long, okay, they've now said, let's just focus on the labor market, man. That's it. Change the definition yet again. So if no one's paying attention to it, it's not going to matter really, is it? Doesn't make sense, does it? In other news, ladies and gentlemen, we just had some bad boy news about Nvidia. Check this out. Well, hold on. Here's the bad news about Nvidia. China's now stopping anyone buying Nvidia chips from China, that is. Well, we already know that Nvidia is going to be suffering with revenue issues to the sum of around $2 to $5 billion in the future. And now it's just said this, okay? Then Nvidia is now looking to expand on its balance sheet and help Intel. Nice play. It's going to invest $5 billion into Intel. Says here, Intel Corporation shares surged dramatically in pre-market trading on September the 18th, 2025, jumping to an extraordinary 28.59% to $32 of pre-market hours following a groundbreaking announcement. The catalyst behind this massive surge was Nvidia's surprise decision to invest $5 billion in the struggling chip maker, marking one of the most significant partnerships in the semiconductor industry. Well, ladies and gentlemen, I've said this before. What will come with investment will come with acquisition. Can you imagine if Nvidia does have the capacity to just go and buy up Intel all day. It really can. Take on all of that. Happy days, ladies and gentlemen. Then you are truly in the game of Monopoly when it comes to the AI markets. They only need to get hold of ASML, which decides whether Nvidia should be allowed to make these chips or not, or make the chips think. Anyway. Let's just dive into a little bit of crypto, shall we? The gentleman last night that was in this trade, okay, is still running shorts on Bitcoin, but he's now $500,000 down on that position. But he's not really got that much of a position on it. Let's go and have a look at our boy Bitcoin. Thank you, NASDAQ. Well done, Bitcoin. Nice. Nice of you to join us. Bitcoin's currently stuck at this Asian session range, $17,000, not really giving us anything. I mean, the thing that you've got to take into consideration with the cryptocurrency story is what's the ETF doing right now? Let's have a look at that. ETF at 764,000. Where are our inflows, outflows? Okay, then. So, not really that much activity yet, but we haven't had it updated per se. Yesterday was minus 536 from actual Grayscale. iShares came in at 1,028. So there was a little bit of distribution across the board, but BlackRock came in with some flavor. I really want a long NASDAQ right now. Anyways, we've got to concentrate over here. So let's just quickly go and break it down in other aspects of crypto. Let's have a look at where we are with open interest. So check this out. In front of you, right, we've got the open interest, these bars, all right, is where people borrow money on leverage, you know, you like degenerate. I'm a degenerate. I was using 5,000 to 1 back in the day. So anyone that says to me, I'm using 200 or 100x leverage and you're being frowned upon, don't worry, my friend. I was on 5,000 to 1 and there was an exchange that offered me 10,000 to 1. And that was an absolute amazing time in my life. We ripped it apart. People are like, how much money do you need to start trading for a living? Well, I started off with about $10 and then turned it to like 15 grand when I was trading leverage back then. So yeah, didn't really need much, ladies and gentlemen. But nowadays we don't have that because they then regulated Forex and then they stopped all of that fun and games. Now I've got a measly 500 to 1 leverage, which is absolutely dog. But Forex leverage is different to cryptocurrency leverage because in Forex, yeah, you have the swaps, but you don't necessarily have funding rates per se as you do in crypto. But in front of you is the open interest for Bitcoin. Now, what's interesting about this is we've got this level here. For me, the 110,000 zone is a very important point for Bitcoin, okay? Because you can see that we've got quite nearly close to $1 billion in open interest at the 110 zone. So if price were to come down to 110,000, that would be logically a good area of support to spark the interest of the participants who were previously long in that range. If you look over here to the left, you can see at 107,000, there was much accumulation inside of that range, which effectively led to a retest into it and commitment even further to the upside. We've now come back into that range and they've bounced away from it. Again, tested that range and now bounced away from it. So now we've got this next level right here at 111,000. We look to the left, we can see we've got some more accumulation on open interest. So we know that from the current price point down towards that 110,000 region, we're going to be expecting commitment to come into play with Bitcoin. But one thing you've got to take into consideration is this. The frequency of the way the ETF is sold as Bitcoin's price goes up or down, correlate that to the open interest that you see in the markets. Why? Because futures markets usually tend to dictate where the spot market's going to go. Why? Because you've got more volume changed on futures markets. So when you start to see the ETF itself losing its balance, okay, and there is a pullback on that, don't start wetting the bed thinking, oh my God, Bitcoin's going to collapse. No, there is going to be profit taking as Bitcoin prices rise. But as long as the ETF balance sustains itself and it still shows accumulation, correlating that over to the open interest, there's the participants who are buying the Bitcoin for the ETF, okay, you know, the authorized participants is what they like to call them, all right, you know, your BlackRocks and all those guys, and then the transfer agent comes and says, give me the Bitcoin, thank you, greatest money heist in history, I'll take that and go and store it in a bank or in a vault, right? They'll take that, and then they'll look at something like open interest, okay, and you can gauge the idea of where the commitment is. So don't wet your minds on whether Bitcoin is dropping on the ETF balance, because there will be accumulation and distribution. But looking at open interest, you can see where the speculators are putting the money down, and then you can make the assumption and say, okay, then this low right here seems like it's a strong low. The only next logical spot for Bitcoin would be the next point where investors will then start to speculate on value, which would be the 120,000 region. Take that by the hybrid system and look to the left, and you can see on the higher time frames, let's go and have a look at that. You can see on the higher time frames that you've got this massive red vector candle, which I am in anticipation. In anticipation of price coming back up towards this red vector candle zone. Okay, so now this is what you've got to take into consideration. Now that we've had the rate cut, anything else from now up until that point, or until the next rate cut, is all going to be determined on the beauty of the data that comes out. If we get data that suggests that the economy is starting to contract, but more primarily, if there is a problem with the labor market and it starts to exceed more losses, okay, and companies start to actually unemploy people, well, actually lay off people, and we do see more people claiming benefit, and we do see a reduction in the non-farm payrolls, then it would be safe to say that the rate cuts will then be coming in line to stimulate the economy to get those people back into work. What the Federal Reserve is hoping for is the fact that we've got the interest rates at 4.25% right now, and the idea is that the data that comes out is going to be suggestive that the economy is starting to struggle a little bit, which will then effectively reduce the outlook on inflation. But if inflation still is high because of tariffs or because the labor market is still stubborn, then out of the two, labor market, housing market, which one is going to cause the bigger issue? We know historically that cyclically, housing markets are very, very prone to changes in interest rates. But a 25 basis point cut ain't great. We need at least 50 or even 75 basis points to get the person who wants to commit to buying a house and get on a 30-year. But if the Fed is not cutting the rates to encourage that, then that means you're going to have a lot of people with cash behind them. You've got a lot of financial companies that cannot sell financial instruments to encourage people to take on these mortgages. Your economy starts to slow. And in that principle, the labor market will then see the impact of that. That's pretty much it. The market is now open. I just chewed your ears off for a little bit. So to summarize it, every bout of data that we get regarding the US economy, it needs to be bad. Because if it's good like today, then we're just reducing the odds of a great rate cut in the future. You know? Cool. Anyways, I have to go and update Platinum members. We've got some movement in the market. I'm just going to lose my shit with NASDAQ for a little bit. But tune into tonight's live stream or video. It depends which one I fancy doing. Take care of yourselves, gang. Hit the like button, subscribe on the way out, and I'll be tuning into you all later. Peace.